Hi and welcome to my channel. Today we are going to take a question on calculation of cost of capital. And before we go into the calculation, let us just brush up on the basics and the formulas that has to be used to calculate the cost of capital. So, cost of capital, there are cost of equity, cost of debt, and cost of preference shares. And what is the total cost of capital? It can be calculated using WACC. WACC is your KE into equity value by total value of capital plus KD into value of debt by total value of capital plus KP into preference share value by total value of capital. So this is WACC or the cost of capital. Now, before we calculate WACC, we need these details, KE, KD, and KP. So, usually the question in the exam will test our understanding on calculating these three costs and then calculation of WACC. So, KE is cost of equity. It can be calculated using the most commonly used is CAPM, that is Capital Asset Pricing Model, and GGM is Gordon's Growth Model. Capital Asset Pricing Model, KE is RF plus beta of RM minus RF. Now, what is RF? RF is your risk-free rate of return, like the rate of return of a government bond, a treasury bill. So that is a risk-free rate of return. Beta is the measure of sensitivity. How sensitive your stock in hand is compared to the market is beta. RM is the expected market rate of return and RF is again the risk-free rate of return. We plot all these figures, we get cost of equity. There is another way of identifying cost of equity, that is P0 is D1 by KE minus G. Current price of a particular stock is the dividend expected at the end of year 1, that is the coming year, by cost of equity minus your growth rate. So plotting this in a different direction. So KE will be D1 by P0 plus G. We are just replotting this formula to get the KE formula. So KE will be D1 by P0 plus G. KD is cost of debt. What is the cost of debt? Cost of debt is generally your interest. So an interest is tax deductible. So interest into 1 minus tax. If there is any flotation cost or there is a redemption at a premium, then we need to add the premium part also, that we will see how we will be doing it in the question that we have in hand. KP is the dividend. Dividend payable will be the cost of preference shares again plus any flotation cost. Now we will go to the question. So this question is to calculate WACC and they have given us the details to calculate all the cost KE, KB, KD and then apply it based on book value weights and market value weights and calculate what is the WACC or the weighted average cost of capital. So first we will calculate KE. How to compute KE? We have certain details from the question that we can plot here. First one is the price. Price is 22. Then we have flotation cost, which is 20. Then growth rate is 7%. D1, dividend expected at the end of the year. So that is D1 is 2 per share. So from this we can calculate KE. KE is D1 by P0 plus G. Right? So plotting this here, 2 by P0. P0, here we have the price to be 22. We have a flotation cost of 2 rupees. So the net price will be 20. So D1 by P0. P0 is our market price minus flotation cost if any. This plus our G, 17. So 17 is our AE or cost of equity. So next we will see KD and KE respectively. KD we have redemption value given as 100, which is our sale price, and then there is the issue price which is given, that is again 100 with a flotation cost of 4 rupees. So my issue price is 100 minus 4% flotation cost, so it is 96, and coupon rate is 13%. By TM, that is year to maturity, is 10 years, and tax is 50%. So the formula for calculating KD is interest into 1 minus tax plus redemption value minus issue price. What is the difference? That is the cost, flotation cost, and that flotation cost is spread over n number of years, right? For it is from, for the issue price is on day one, and the redemption value is 10 years later in this question. So the total cost is spread over 10 years. So by number of years. This is my total cost. The total cost upon the redemption value plus issue price by 2. So that will be our KD. So plotting all the items in this formula, which is interest 13 into 1 minus 50% is my tax rate. Yeah, so my interest cost I have taken, then I need to take my flotation cost, which is 100 minus 96 spread over 10 years by 10. All of this by the average of my issue price and my redemption value. Which is, this is our cost of debt. Okay. Now next we will see KP. We have redemption value given, which is 100 rupees per preference share redeemable at par. So it is 100. YTM is again 10 years. Dividend is 14%. Flotation cost is 5%. So my issue price will be 95. 100 minus 5% of 100. There is no tax applicability for dividend because it is not a tax deductible expense. For KP also the formula is same. Only difference is that we will not be reducing any tax for this dividend part. So dividend is my cost, which is 14 rupees for per 100. Plus what is my redemption value? 100 minus my current issue price is 95. This flotation cost of 5 rupees spread over 10 years. So by 10. So this gives me my total cost by the average value. So it is 100 plus 95 by 2. Okay. This will be my KP. So we have got all the costs now. WACC calculation as per book value, the debt, preference and equity ratio is 8 is to 2 is to 10. And as per WACC, as per book value. Now WACC as per market value, we need to convert the book value into market value. So here the book value is 8 lakh for 100 per share shares, 100 per share debentures. So I am converting this 8 into my market value is 110 by book value 100. So I'll get the adjusted market value. Preference shares, it is 2 by 100 into 120. And my equity is 10 by 10 into 22. So all the market prices are given in the question. We just have to replot it. So the WACC calculation will be cost of debt into 8 by 20 plus cost of preference shares into 2 by 20 plus cost of equity into 10 by 20. So it is 12.8. And WACC as per market price will be cost of debt into 8.8 by 33.2, which is the total cost, and cost of preference shares into 2.4 by 33.2, and cost of equity into 22, 33.2. This is the WACC as per market price and WACC as per book value we have calculated. I hope this video was insightful and you got a great idea about how to calculate cost of capital and WACC. Stay tuned for more such videos and subscribe to our channel. And in case you need any a tutorial on any of the topics, you can mention in the comment box and we will try to take it up in the next videos. Thank you.